What's up, investors? It's the Russian dude. Let me immediately show you the fear and greed index, how it changed from the previous day. First of all, on stock market, we can see it is now a little bit more back to fear, 39 out of 100, and the crypto market is more or less greed, 64 out of 100. Then we can see that the netto outflow of Bitcoin ETFs last day reached $15 million approximately, which is, yes, there is an outflow, but it is insignificant, because the inflow for the last 2 days respectively was $2 and $300 million. But what is a little bit concerning is that the number of Bitcoin whales, it kind of flatlined, there is not that much increase anymore. Why this can be more concerning? Well, Bitcoin whales are the ones who can collectively or even individually affect the Bitcoin prices. So basically, whenever you don't have that many of them anymore, or when worst case scenario, even if they just become passive and they just start holding, this can most certainly significantly affect the crypto market. Now let's briefly talk about why some people and stock analysts, they see that there are some signs that the dot-com bubble 2.0 can come once again, and what evidence they bring to support these claims. To begin with, right here is the first graph, which shows that April was a pretty negative month for stocks, but then in the first weeks of May they started to rebound at least a little bit, which is, to be honest, is a little bit unusual, because historically it is exactly the opposite. April is the month which is performing pretty good, and then May is when, you know, there's this saying, sell in May and go away. We are just in the beginning of May right now, so everything can change. So in case it does go in accordance with the history, we might see some very bad declines in this month. Then right here is another interesting graph, these so-called pandemic top 50 stocks, which were extremely popular during the events of 2020, like Peloton, Zoom, all this kind of stuff, like work from home kind of companies, right? So they obviously did explode in 2020, but since 2021 until now, they lost approximately $1.5 trillion of the joint combined market capitalization, which is huge. On average, the decline for every single one of them was approximately 33 to 35%. Once again, on average, some companies dropped as much as more than 90%. So it kinda shows you that there is no like life-changing company which makes bikes for you to train at home, like Peloton. People thought that this will be like a $1 trillion corporation. Well, it just doesn't make sense, right? So, another thing, since 2011, what was helping stocks in general to grow a lot was corporate buybacks. As you can see from this graph, the corporate buybacks, they steadily increase, especially in 2024, and it is also expected for them to be higher in 2025. The way it works, in a very simple understanding, can be summarized in these two ways. The reason number one is whenever a company is buying back its own shares, it's not just buying like us, retail investors. It's not buying like 50, 100, 200 shares. It buys thousands or even millions of them, which obviously creates a lot of demand rather than supply. And the reason number two, whenever they buy back their own shares, obviously the supply of their own shares on the market decreases, which in fact increases once again demand for them, because there's now simply less supply. But buybacks obviously cannot continue forever, especially if it's a technological company. It is much more preferred to reinvest this money back into your own company for example, research and development, mergers and acquisitions, things like this, rather than just buying back your own shares and artificially inflating the price. But this is pretty much exactly what the majority of biggest companies were doing in the past. That is why at this very moment the total weight of top 10 companies in the S&P 500 reached almost a world record, historical record number, 34% of only 10 companies within the S&P 500. Once again, they occupy 1/3 of the entire index, while the rest 490 companies, they only represent like 65-66%. And one of the last times something similar happened was right before 2000's dot-com bubble. So a lot of analysts, they see similarities right now. A lot of biggest companies in the S&P 500, they represent a big weight inside the index itself. And one of the main reasons why they just keep growing, once again, they are doing stocks buybacks. What happens when they stop doing these buybacks? Well, you can already assume if these 10 companies, they start going down, without a doubt, they will drag the entire index with them. But that's not even one of the most concerning news for today, because right now the Wall Street, the so-called smart money, well, guess what, they again started revising their interest rate expectations. And well, right now they do think in this year, in 2024, the interest rate cuts will either not happen at all, or there will be minimal number of them, 1, maximum 2, which is way less than the Federal Reserve expects itself. And we already talked several times in my previous videos why this is a bad thing specifically for technological companies, because like interest payments are extremely high, and whenever you're a technological company you do use a lot of borrowed capital. So for you to maintain this capital it takes a lot of interest payments, and if you don't use borrowed capital to do multi-billion research and development activities, well, your company, the development of it simply slows down, right? And well, another thing, and yes, I'm gonna once again talk about the US debt catastrophe. Well, in 40 years, the US national debt increased only from mere $1 trillion to $35 trillion. Only. In last 40 years, you can see that this graph was just in geometrical progression going up, and only in the last year alone the US debt increased by $3 trillion, once again in 1 year alone. And you already know that the high interest rates will make the debt interest payments completely unbearable for the US economy, but well, this is what they'll have to do. They brought this situation upon themselves. Nobody asked them to continue printing money when the economy was already showing strong signs of recovery. Well, they still continue to do this. Now, when there are actions, there are consequences. And because of this, a lot of analysts, they start talking about the risks of the stagflation. Stagflation in very basic understanding is when the GDP, when the country itself, the development of the country is extremely slow, when there is also high unemployment and high inflation. Sounds familiar, right? Exactly what we are going right now. The US GDP is not growing as fast, the economy is, the unemployment is increasing, and the interest rates are still high, the inflation is still high. Well, this is a perfect recipe for stagflation, which is pretty much the worst case scenario for any economy, let alone #1 economy in the world, the United States. And just to make things worse, pretty much the last nail in the coffin is Jim Cramer. If you're familiar with this guy, every single prediction he makes, it is like, it just became an internet joke. Any single decision, any single statement he makes turns out to be completely the opposite. He says, Bitcoin is gonna grow, Bitcoin goes down. He's gonna say Bitcoin is dead, Bitcoin explodes. Well, recently he said that he thinks that the correction on the US stock market is now officially over. Well, you can, guys, connect the dots. As always, guys, thank you so much for watching. Please like this video and subscribe to my channel. I'm making these updates pretty much daily at this point, and see you tomorrow.